Welcome. I'm at the JPMorgan India Investor Summit 2019. I have a guest with me who needs no introduction, but I'm anyways going to introduce him. Bharat Iyer is joining me right now on the show. Bharat, thanks very much for taking out the time.
Thanks for coming to the summit.
It's, I've not been able to get out and get the mood, get a feel of the mood there right now. I'll probably do that post I'm done with the interviews. But you've managed to talk to people around, what's the mood like? What's the sentiment?
There's a lot of enthusiasm there. We have nearly 80 companies out here. We have nearly 300 investors here cutting across asset classes. We expect to have a lot of senior policy makers. So I guess the enthusiasm to look at India as an investment destination has not diminished. Really?
I mean, considering what we've been looking at, okay, maybe equity markets is just a one point of view where we've, post-budget, there's really nothing that's happened from a foreign investor point of view. And would you really think that after a print of 5% that we did in terms of growth, it's still an attractive destination?
See, Devina, I think, summits like these are meant to showcase the structural opportunity that India presents. Sure, there will be cycles, and, I think we're going through a cycle, and perhaps we are at the bottom, or at least we hope we are at the bottom of the current cycle, but I don't think it takes away from the structural appeal. And that's what we're seeing in terms of enthusiasm around us.
So let's talk a little bit more about, where do you see us going from here? Do you think we've sort of troughed out in terms of this slowdown that we are seeing, or it's going to be slightly more prolonged? Because in each and every sector is in some form of pain. It is going to take some time before you actually kickstart the growth engine once again, or maybe just the base effect plays out for you.
Well, Devin, I think it's going to be a recovery from here. I think we've largely troughed off. But that said, I think the recovery is going to be gradual. What drives the recovery into the second half? I can think of three factors, actually four, now that you mentioned the base effect. But apart from the base effect, I think we have to appreciate that we've had a normal monsoon. That should bring some kind of demand back to the markets. I think we'll see the return of government spending after the election cycle is done with, and I think monetary transmission on the margin will start picking up. So I think we start seeing a gradual recovery, which perhaps takes us from the 5% levels to around the 6% levels. But as I said earlier, the recovery will be gradual. We shouldn't really expect a V-shaped recovery at this stage.
So even from an equity market investment standpoint, it should not be hurried. Pace it out, as in wait it out, see things changing.
Absolutely. That's been our call to for some time now, for the last 2 or 3 months, that look, this is going to be a year of modest returns in a volatile environment. Because, the volatility is not just local, right? Even if you look beyond India, we are in a volatile environment.
Yeah. Is it going to be, so far, budget post that has been India specific. We've been charting our own course. Now, global factors are looming larger than our own domestic issues. Add to that, the spanner in the works has been oil and Saudi Arabia. How big an issue is it going to be for India to cope with the global issues?
See, I don't worry too much about a global recession's impact on India beyond the normal and the obvious, because we're a relatively small part of the global supply value chain. And perversely, a global slowdown could help India in certain ways, particularly in the form of lower commodity prices. So that's something I think we can live with, because we are an economy which is largely internally driven, not driven by trade and exports. But what I do worry about is the spike in oil prices. Currently the view seems to be that it's temporary. But if this is something that sustains, we really don't need oil at $70, $75 a barrel at this stage in our recovery.
Yeah, and not to say the implications of a sustained higher oil price on the CAD calculations and the overall.
No, it impacts everything. It impacts the CAD, it impacts the currency, and it can potentially impact either or and the fiscal deficit and inflation. So that's something that one needs to keep an eye on.
So that is an imminent risk, and that is something that if a foreign investor is looking at, and if you were to take a call on whether you want to invest in India as an emerging market or another emerging market, why would you choose India?
Well, at this stage, you're right. If oil were to stay above $70, $75, it does put pressure on India in a cyclical manner. But the expectation really is this spike in oil prices has been caused not by economic fundamentals, but by geopolitical factors, which you would expect to wane, where you would expect a much stronger policy response. And if that were to come through and oil stays well behaved, then there's no taking away from India's appeal. Particularly, I think there are both structural reasons and there are near-term reasons. As I mentioned, if trade wars is your main concern, then India is relatively insulated. And I guess, longer term, the combination that we offer in terms of demographics and the need for infrastructure investments is something that's unparalleled.
So why have investors stayed away?
I don't think investors have stayed away.
Or rather have been pulling out?
I don't think investors have stayed away, Devina. If you look at it overall, I mean, emerging market investors on aggregate are running a neutral position on India vis-a-vis the benchmark. You know, in the benchmark, our weight is around 9%, and I think they're at 9.2, 9.3%. So I don't think investors have really been underweight on India or have neglected this market. And you know, we have to appreciate that this neutral position is despite earnings having underwent for 4 or 5 years. So this just shows, I mean, how well they appreciate the structural opportunity. But for them to go overweight, we'll have to offer, you know, a more robust earnings cycle.
Yeah, and that will take some time, you say?
That should take time because, you know, as I mentioned earlier, the base case is that, you know, the economic recovery will be gradual, which means that, you know, you perhaps have another year of underwhelming earnings. I think consensus earnings expectations are north of 20%, and perhaps you'll get low double digits. But that will still be an improvement in relation to, you know, the trend we've seen over the last 4 or 5 years. But yeah, it's, you know, 15% earnings growth that really will bring them back in a very meaningful manner.
And therefore they find the valuations compared to other emerging markets
Absolutely.
expensive.
I mean, India is trading at about, you know, if you look at FY20, we're trading at about 20 times. If you're looking at FY21, we're trading at about 18 times. And EM on average is about, you know, 30% cheaper.
Yeah, so FIs don't really have a separate allocation to India. I mean, it forms the emerging market basket and a part of that. While they've not really gone underweight and they've stayed neutral, do you feel with China opening up and removing restrictions of investments, that pie for India becomes smaller?
In a tactical sense, yes, it could happen. But I think there are factors that should drive India's weightage back up over a period of time, because, you know, you'd argue that, you know, we'll offer superior and more sustainable growth, because let's face it, the rest of the world is also slowing. It's not just India which is slowing. And more importantly, our free float factor is on the lower side. I mean, it's perhaps one of the lowest amongst the peer group. And that's where I think, you know, the government's decision to increase the free float for publicly listed companies from 25% to 35% is actually, if implemented over the medium to long term, a very positive step, because it will take our weight in the indices up, which is currently underrepresented in relation to the size of our economy.
You feel, I mean, so since you're talking about slowdown and a global slowdown as well, you know, pain in the Indian equity markets, do you feel is that much more exaggerated, or it's you know, par for course, and we've been seeing fundamentals not playing out, and therefore you know, prices coming down to
it's
what
a combination of factors, because, you know, it's not that, you know, globally there's this tidal wave of money coming into emerging markets.
I mean, S&P 500 is near record high still.
That's the exception rather than the rule. So what you've really seen is, you know, the US has been the outlier both in terms of growth and in terms of market performance, whereas the rest of the world has trailed both in terms of growth and in terms of market performance. So I guess, you know, the stress we are seeing in the equity markets is a combination both of, you know, relatively neutral flows into emerging markets at large, and including India, and also in terms of, you know, the slowdown that we've seen. But again, you know, appreciate that, you know, if we start delivering the appropriate policy response and growth, there is money waiting to be coming in. Just look at what happened over April, May, June. I mean, at one point, you know, we were having net inflows this year of $10-11 billion. Yes, we've seen an outflow over the last 2 months, but that can reverse very quickly once, you know, investors start seeing signs that the growth has bottomed out and we're seeing a pickup.
Okay, so are you happy with you know, all the announcements that the finance minister has made? You feel that
yes,
you know, sooner rather than later, the impact of that will be evident?
See, I think, you know, what the government has done is these are a series of incremental measures, particularly in relation to sectors which are going through a lot of stress. See, Devin, I think we have to appreciate that the government doesn't have too much fiscal space to pump prime the economy at large. I mean, consolidated across the central government, the state governments, and off balance sheet, we're running a deficit of almost 9%. It's unreasonable to expect them to, you know, try and pump prime the economy at large and, you know, compromise macro stability. So I guess what is necessary and what is being delivered is a more tactical response, looking at distressed sectors and giving them some leeway through this phase of slowdown, and then waiting for monetary policy to do the heavy lifting.
Okay, so a few things. Firstly, you know, what the consolidation in the PSU banks has been, and do you feel this is the right step at the right time, when the focus should have actually been more on, you know, making sure that there is enough transmission in the system, lending takes place, management bandwidth now shifts towards making sure that, you know, mergers happen in a steadfast fashion. That being one, and the other one, on the similar lines, what they've announced to the external benchmarking of retail and MSME loans, to make sure faster transmission happens. How did you read into both?
See, I think that in response to your first question, I think it's always a good time to do something structural. I think we had too many PSU banks. I mean, it was very difficult to manage them, and I think consolidation is the right answer, and I think they've done it. And you have to, there'll always be questions. Whenever you do it, people will say that, is this the right time? So I don't think, you've just come on the back of a very good and meaningful mandate. So you have a lot of political capital and goodwill at this point in time. So you might as well get it done now when you have that capital and goodwill. In terms of, will it constrain lending? I think, that is an operational issue. That is something that will have to be managed. But I think whenever this step had been taken, there would always be question marks on the time frame. And I think, there couldn't have been a better time frame given that they were coming on the back of such a thumping mandate and the fact that they have so much political capital and goodwill. In terms of benchmarking and linking rates, it's always a difficult question to answer because, I think it's each bank to its own, because every bank has its own profile in terms of, the liability franchise, the cost at which they can raise money, the customer segments that they cater to, both geographic as well as in terms of sectoral. So I think a more nuanced approach is required there.
Okay, just a few more questions since I have you with me. The auto industry, the struggle seems to be never ending. It's been almost a year since we've been talking about the pickup and the slowdown, whether it's structural, whether it's cyclical. But there's nobody can really pinpoint when it'll turn around. What's your gauge on the on-ground situation?
See, I guess as far as the auto sector is concerned, they're at the receiving end of policy-related costs bunching up. So in an 18-month time span, beginning September last year to March next year, you're going to have the sticker price of a vehicle going up by 15 to 20%. You had increases because of insurance, you've had increase because of safety, and down the line you'll have an increase because of emission norms. Now let's face it, in an environment where wage growth is perhaps 5-6%, a 15-20% cost increase means that it's going to take a couple of years before affordability levels match up with the new norm on pricing. And so it's going to take time for affordability levels to catch up and feel good to come in. So have we seen the worst in terms of month-over-month declines? I would say yes, but are we going to see a very sharp rally? Unless GST is cut, I don't see that happening. I think the recovery will be gradual.
Okay, last question.
Sure.
Where is JPMorgan overweight in India?
In India, we are overweight on financials, particularly the large banks, because we think that the worst of the credit cycle issues are over for them. We see loan growth returning, we see policy being supportive, and most of them have a very solid liability franchise. We think that the incremental stress we are seeing in terms of credit cycle issues are more mid-corporate level, and they're going to impact the smaller banks and the NBFCs more than the large banks. So that's one area where we think there is value. We like the insurance space. We think that it's a very underpenetrated market and there's a very long runway. So that's another part of financials that we like. We think that companies associated with the government's investments in priority infrastructure areas, be it roads, be it affordable housing, be it water, will all tend to do very well. So areas like cement, select capital goods and construction companies. Lastly, I also think there's a lot of value in these state-owned companies. Some of them have very dominant franchises. They're trading at almost one-time book, offering you dividend yields of 6 to 9%. And I think if there's a more well-articulated divestment policy, then there's meaningful money to be made here.
Great to hear from you, Bharat. Thank you so very much, and all the best for the conference.
Thank you.